This episode of From Angel to Exit is brought to you by the CEO's Right Hand. The CEO's Right Hand provides customized outsourced finance, accounting, and human resource services tailored to small and medium-sized businesses. Their services include fractional CFO, HR support, capital raising, and financial infrastructure development. They emphasize personalized engagements and expert support to drive growth and operational efficiencies. If you want to find out more, visit theceosrighthand.co. Are you serious about planning a successful business exit? From Angel to Exit is your go-to resource. Subscribe to our newsletter at eckfeldt.com/podcast for even more valuable insights. And to get personalized guidance, take our free exit readiness assessment. It's just 24 questions, and it will give you a clear picture of your exit readiness. Find the assessment at eckfeldt.com/exit. Submit your results, and we'll schedule a free follow-up call to discuss your specific situation and the best way to maximize your valuation and ensure a successful transaction. Now, back to the episode. Welcome, everyone. This is From Angel to Exit. I'm Bruce Eckfeldt. I'm your host. Our guest today, Lee Minkoff. He is Managing Director at Renovus Capital Partners, private equity firm. We're going to talk to him about the world of M&A, what he's seeing in the kind of the market right now, and kind of get his take. I think this is going to be a fun one because we talked to a lot of people, a lot of founders who have exited. We get to talk about the other side a little bit, folks that do the acquiring, that do the buying, kind of get their view, opinion, sort of see what's working, what's not, and kind of his experience of working with lots of sellers. Some of the things that go well, not go well, things that can go better. So excited for the conversation. With all that, Lee, welcome to the program.
Hey, Bruce. Thanks for having me. I'm pumped for today.
Yeah, no, it's a pleasure. I know we've talked a lot over the years, and so it's fun to get you on the program and actually get into this a little bit. So before we get into what you're doing today, I would love to get a little background for you personally. Like, how did you get into this space? What was your professional background? Give us a story.
Yeah. So I got into private equity, I guess, in 2016. I was in investment banking before that. I guess stepping all the way back, I'm a Philly guy. I'm sitting in Wayne, Pennsylvania right now, outside of Philly. Was born and raised outside of Philadelphia, stereotypical Philadelphian. Went to Penn State University, and then after Penn State, went to New York. Worked in investment banking at UBS. Before UBS, I was in asset management at JP Morgan. But coming out of banking, recruited for private equity. Worked at a firm called Lee Minkoff Partners. It's headquartered in Philadelphia, had offices in New York and LA. And that moved over to Renovus Capital 4 years ago. Lower middle market private equity firm. I joined to launch our professional services vertical, which is one of our 4 verticals. We invest in what we call the knowledge and talent industries. It's all human capital businesses. We've got education, healthcare, IT, and then I lead our professional services vertical. So responsible for deploying 20 to 25% of the capital of each fund. So originate, deploy, execute transactions, grow those companies, and then ultimately exit those companies.
Yeah. I'm curious, just because we use the term private equity a lot and kind of different ways. Can you give us a little sense of how you kind of organize or structure or think about the private equity space and how you and the firm kind of fit into that?
Yeah. So great question. So from a strategy perspective, we are buyout investors, leverage buyout guys. So we're buying the control of companies, generally buying from founders. 85% of our transactions we're buying from founders, families, owner entrepreneurs. We're the first institutional capital in. And the use of proceeds is secondary. We're buying out their ownership and taking ideally a majority position in the company. And that part of the purchase price comes from our funds, our committed equity capital. And we also use third-party leverage as part of the financing. So that's like the strategy is buyout. Then where we play in the market, some firms say they're lower middle market. We say we are lower market. So true lower market micro cap investors. And
what does that mean? Like in terms of revenue?
So sub 10 million of EBITDA, I would say. But really like mid single digits. Our average EBITDA at entry is around 6 million. And we'll do deals as small as 2.5, 3 million of EBITDA for the initial platform. I say we don't invest in platforms, we invest in theses. We could talk more about that. But we'll start pretty small. So if you look up Renovus, we're a highly ranked, we're actually the number 1 ranked small cap private equity fund by HEC Paris Dow Jones. But we really think of ourselves as lower market investors buying founder-owned companies in a buyout strategy, scaling those businesses, really creating premium platforms, either for larger private equity firms or add-ons for strategics or private equity-backed strategics.
Yeah. Yeah, I know a lot of firms that, have kind of deal minimums and things like that. They want to, bigger companies and stuff. Why focus on this lower, kind of lower market, and what do you do to be able to kind of run those transactions effectively? Because I know a lot of times it's just the deal cost is tough to do, at these lower levels. How do you manage that?
Yeah. So it's intentional. We think the most opportunity in private markets is the lower market. We think the greatest ability to add value and drive alpha in these companies is at the smaller end of the market. So if you're an institutional allocator, I think everyone pretty much has decided they want to invest in private equity. Then they decide they want to be within the various buckets of private equity. They have an allocation to buyout. And then from there, it's like if you've decided you've made the right decision that you're going to allocate to private equity and buyout, I think the greatest market for alpha, number of investable opportunities, valuations, kind of the maturity level of these companies and the ability to create value, right? Revenue, earnings growth, acquire additional companies, pull all of your kind of value creation levers. I think the greatest opportunity is at this end of the market. So the game we are playing is to win in the lower market and scale up these companies so that they can be premium platforms for, again, middle market, upper mid market, even large cap private equity firms or strategics.
Yeah. And so what are your kind of deal qualifications or prospect qualifications? Like, what are you actually looking for in terms of situation, the kind of structure of the company, financial performance? Like, what really drives interesting deals for you?
Yeah. We call it the Renovus deal. Like, there are characteristics of a Renovus deal. And we talk about with like our team and analysts and associates and people coming up in the firm, like trying to understand what a Renovus deal is. That is, the company is operating in one of our core verticals, right? So the model of the firm is knowledge and talent. Those are companies where the enterprise value is driven by the intellectual capital of a highly educated workforce. And then within, we've got education, healthcare, IT, and professional services. And then each vertical has its own kind of sub theses. For example, my sector, we like legal, we like accounting, we like wealth management. Those are areas where we're gotten really smart, and we're investing in a thesis where we pick a tailwind to invest behind. And then we find companies. These companies, ideally, they're founder owned. They have less than 10 million of EBITDA at entry, at least the first deal. They are growing. We are not buying flatlining or declining businesses. We say if you're declining or flat, you're basically worth nothing. So we're buying growing companies, but there is some sort of hair on the business. The market has some kind of complexities or potentially regulatory headwinds that need to be navigated. There's a lot of customer concentration. Maybe there's founder, certain salesperson, or delivery risk. There's some sort of hair. I would say, I like what our founder, Jesse, says. He says, we buy B companies and turn them into A companies. These are like good, solid companies, but they haven't been totally optimized yet. And we're able to come in and use our expertise and know-how, our operating partners and portfolio resources. And we can see the transformation levers. So when we buy these businesses, we know that we're in the money day one, right? We know exactly what we need to do to make these companies not only bigger, but to actually sell at a higher valuation multiple than we paid. So we have our playbook, we call it the RCP playbook, and we apply that to a Renovus deal, and we know what we're doing. So I would say that situation, that dynamic, describes a Renovus deal. And then from that initial platform per se, which is the first of the thesis, we're going to do ideally many add-ons and many more Renovus deals within that thesis to really create a premium platform company.
Got it. So you kind of have two types of deals. So you can kind of the original kind of thesis deal that kind of sets you up, and then you're going out and finding things to kind of plug into that create the scale and volume.
Exactly. And what's interesting with us is I want to say, let me see if that's right. 4 of my 5 current platforms, we have done an add-on that is bigger than the initial platform, right? That's why I don't like to use the word.
No, bigger than when you did it, but was it was the acquisition bigger than the platform at the time of acquisition?
We have done a subsequent acquisition that was
Yeah.
bigger than the first
Yeah.
acquisition. So if I think about a company called Harbor, our third acquisition was actually the largest. We did 10 acquisitions. Number 3 and number 8 were the largest.
Yeah.
With F2, we found an add-on, I guess per se, the day we closed the initial platform that was bigger than the platform company that we first had under LOI. And our 5th deal was the largest from an EBITDA perspective of the 5 that we've done so far, and including the 6th that will close later this week. The 3 that we were talking about, where we're combining 3 companies at once. Third that's closing is the largest, the one that hasn't closed yet. And so it's oftentimes where we've gotten this thesis, we've gotten into a small company, we get our capital in, we are learning about the business as we're continuing to run up. We say, you can't really totally know a company. You can't diligence everything about a company. You got to be in the company to kind of know everything. And so it's helpful to get in, learn a lot as you're, operating the business and running the business, and then do subsequent acquisitions that are larger. We can put more equity to work. We've got more purchasing power with our debt capacity. And so it's a strategy that we've used successfully.
Yeah. And how do you source your deals? Like where are you finding these companies? How do you do your outreach? What's the pitch? Are these proprietary, or are you going out to, companies that have put themselves on the market?
It's a mix. Certainly go through the investment banker and kind of broker channels. We have a 3-person business development team. Their entire job is originating, opportunities for us. We look at over 1,000 deals a year at Renovus. And so I think it's just a differentiator for private equity firms in general that have a devoted sourcing arm. I think what further kind of helps our sourcing arm is the fact that we go to market in these 4 verticals. So I'm tasked with sourcing deals. It just, at this point, it's sort of natural. I don't even call it sourcing. I think it's just networking. But because I'm a professional services focused investor, all the professional services bankers are covering me, and I'm staying in touch with them, and vice versa. They're staying on top of my portfolio companies and where I'm spending time in the market. And so there's a good amount of flow from the investment banker and broker channels. That said, I think we are doing more proprietary opportunities. We're executing on more proprietary opportunities than the average multi-billion-dollar private equity firm. Again, it's a benefit of us being very focused in our end markets and desiring to do deals at the lower end of the lower middle market.
Yeah. And what's the kind of process look like for you? Like where do you start? What do you kind of want to know first? How does this unfold? Like how do you actually evaluate an opportunity to decide, like, and what are your gates around that? I'm curious.
Yeah. First thing, it starts with the thematic campaign. I joke that I'm not smart enough to meet a founder or get a SIM from an investment banker and decide that this is a end market or a business model that I like and want to use my firm's time and capital to, vet this opportunity. So we've got these very high level themes that are driving where we're spending time. We've obviously got our existing portfolio companies, but every year we're doing business planning. We're actually like kind of calling our shot or writing our story and saying, we're going to find a platform or, execute a thesis in this end market, which will be a new thesis for us. We go about, there's a calling effort from our team, the professional services team, the business development team. Sometimes we'll use buy-side brokers as well. We're going out, we're canvassing the market, we're finding hundreds of opportunities. And it's a numbers game, right? You're trying to meet lots of founders, lots of business owners. And what's nice about targeting a certain market is that's like the easy job. Like we've already identified that we like this end market. I think end markets drive a ton of organic growth in companies, right? If you're a good end market, you're going to get some level of growth. That's kind of your beta. Then it's like, are you a good company? Do you have a good value prop? Is your team good? That's sort of your alpha, right? And then the hard part is like the people, right? That's like all businesses is people, right? But we have alignment with the founder. Do we have alignment with the CEO? Do we need to make changes? Are the owners okay with those changes? Can we work together? Or is it a Renovus management team? Are we, as Renovus, the right sponsor for them? So it's all about fit. I think it takes a lot of time investment. I think it's good to be in person. I think it's good to...
And those, like, I'm always like, I'm just always curious, like what actually, like what would you hear from a founder that tells you that, yeah, I think we might have a fit here?
It's a great question because I almost think if a founder is saying, "Oh, there's a great fit between us," like I almost feel like that's like not natural in a way. I feel like there is this organic meeting of the minds, getting along. Do you enjoy spending time with this person,
Hmm.
whether it's kind of the founder or the CEO? Um, do you want to grab a beer with them? Do you want to play around a golf with them?
Uh-huh.
I think those things. Do you talk about things besides the deal?
Yeah.
Can you find similarities or differences in life that are engaging and interesting to talk about, where
Uh-huh.
it's not just like, how do we hit our return targets and
Yeah.
grow revenue and EBITDA this quarter? Like, that kind of sucks if that's the entire
Yeah.
relationship.
Well, it's not
Uh,
fun.
so I think it's like understanding that you're going to have lots of conversations that are good relationships to maintain.
Yeah.
You can't go in thinking like, oh, I'm gonna buy this company. Like that doesn't work. Founders don't want that either, I don't think,
Right.
right? You know all about this. You've written about it.
Yeah.
Like, this is such a significant life experience for these founders, and in some ways, uh, we're a commoditized product. Private equity, we
Hmm.
sell money. It's the
Yeah.
greatest commodity out there.
Yeah.
Yeah.
It's
What's
like the
not
definition of fungible.
exactly what's not commoditized is what I think the value creation and what we do
Yeah.
with companies after we write the initial check.
Yeah.
But I think on the outset, it's a bit commoditized. It's competitive. You've had other guests on come on and say it's it's a crowded market. There's
Yeah.
lots of private equity firms. There's seemingly infinite supply of private capital, and there's a finite supply of high quality private companies. And
Yeah.
so while maybe the market's turned a little bit in buyers' favors, net, I still think it's a seller's market.
Yeah.
And so I think you have to differentiate as a private equity firm and just about being about a real genuine person and not trying to be something you're not to these
Yeah.
founders that are true, raw, genuine people.
Yeah. I always, it's just, it is, a strange and sometimes awkward process because you kind of go through this kind of transactional part of it, which is, how do I get the best dollar? How do I get best terms? Right. Like you're going to press each other and it can get, it's very like, you got to win, right? Like it's a very kind of win lose kind of dynamic at the beginning. But then you end up doing a deal and now you're business partners, right? And I've seen a lot of transactions where it takes a couple of months to kind of recover from kind of a bloody negotiation process to then actually start working together. And so, yeah, I just really appreciate this whole kind of building a relationship and I'm going to be in the trenches with these people for a while here, right? This is not one and done, right? Like then we got to work together. And I'm curious when you're talking to these folks, what do you find is interesting about you to them? Like, how do you pitch yourself and how do you differentiate yourselves given that, yeah, the capital is a bit of a commodity and there's a lot of private equity out there? Like, why do the companies that do a deal with you kind of do the deal with you from your point of view?
It's a good question. There's a lot of talented people in private equity, and finding someone, kind of going back to the time investment, like I talk about how challenging it is to be sitting on different sides of the table with
Yeah.
someone, and then the day you sign the deal or close the deal, you're now sitting on the same side of the table. I would say we will not do deals where we can't be sitting on the same side of the table day one and things
Hmm.
like life is too short for, it's not because the founder's a bad person or I'm a bad person.
Yeah.
It wasn't meant to be.
Yep.
And I kind of trust that, things happen for a reason. And
Yeah.
so I think that's again, you're like, it's a hard thing to find. It's a needle in the haystack, that right opportunity. How we differentiate. We have a style, right? Renovus is a scrappy, kind of a young, aggressive private equity firm.
Mhm.
What's nice is, we're investing out of our fourth fund. It's an $875 million fund. It is a stable, well-capitalized firm. But in some ways, we're still on like that really aggressive growth trajectory. We feel like we're in the early innings of our own growth.
Hmm.
Founders are young, the team is young, and we're hungry, right? And we're
Yeah.
aggressive. It is an aggressive growth mentality.
Right.
And there's a lot of work to do in these companies. Like in some ways, I think we talk about, in some ways we're playing the easy game in the area of the market that we're playing. We think
Okay.
that the game that we're playing at the lower end of the market is actually better than like the large caps, right? They're playing a different game. They're deploying billions of dollars. They're trying to make, maybe 2x returns.
Yeah.
We're deploying 30, 40, $50 million checks. We're trying to make 3, 4, 5, 6x type returns. So it's a different game. And not all companies are ready for that sort of approach.
Mm-hmm.
And we're also not operationally focused. I would say we have operating partners that are helpful. We have portfolio resources group that will drop in on certain work streams. But as a private equity firm, I wouldn't say we're an operationally hands-on private equity firm.
Yeah.
I would say we are strategically hands-on, positioning, talent, acquisitions, new markets, right? Like we are strategically hands-on. That probably puts us in like the middle of the spectrum of private equity approaches. Operational hands-off, strategically hands-on, we probably end up somewhere in the middle. But that strategic focus and how much we're trying to do to grow the business, it's a lot of work for our executive, right? Because they're also in a people business. So their time is needed to grow the business. This is not a software product or, widget makers that kind of just keep operating on, machinery. There's no hard assets in these companies. We're buying businesses with their customer contracts, IP, and people, right?
Yeah.
So it adds to their day job working with Renovus, but we think that if they buy into what we're doing and cultures align, styles and personalities align, we can create a lot of value together. It's economically fulfilling, but it's also personally and professionally fulfilling.
Yeah. Yeah, it's almost like you've got a little bit of like venture flair on the private equity side. Like you're going a little early. It sounds like you want a little bit more return. You're kind of calculating a little bit more risk versus the big private equity. It's, it is, every deal has to perform, every deal, like, but they're lower returns, right? You're not trying to get the 3, 4, 5x. You're looking for 2x, but so I get that feel that you're a little bit more entrepreneurial, a little bit more kind of venture focused.
I like the venture flair, or like because these companies are like the farthest thing from venture. We're buying like generally very boring companies, but we were looking to provide this like venture like flair, which I'll take from you.
Well, you see an opportunity. You
transformation journey. Yeah. We're not buying companies to like make it 2.5x return. That's not what we're focused on doing. And that's not what we've told our investors. Unfortunately, we've delivered for them, and that's what we're looking to continue to do. And that's why even as our fund size has increased, we're still trying to play in this lower end of the market.
Yeah. How, given the fact that you're dealing with these companies that are very kind of talent, people focused, don't have, ARR and, manufacturing kind of contracts and things like that. Like, how do you do evaluations? Like, what are the levers for you, or what are you looking for to decide, okay, is this, where is the risk here? Where is the opportunity? Like, what's a good kind of talent-based company for you?
Majority of our companies, the majority of the revenue is project-based. So that is a different model than buying a business with recurring revenues, right? Or even volume-based revenues that are really predictable. Couple of elements. I'll go back to identifying the end market. We're looking at end markets where we are highly, highly confident of the TAM level, or total addressable market, or serviceable addressable market growth rates, right? So if that's our beta and we feel like we've got a good company, they're going to meet or exceed the growth of the underlying market, and we're baking that into our models, right? So we're doing market studies, we're doing them in advance of seeing a sim or getting a proprietary opportunity. And so that's our underlying growth rate. Then it's like, what's our ability to exceed and drive alpha of that market growth through just same store sales, keeping doing what we're doing, and then adding new offerings, whether it's new end markets, new service offering, new geo. And then what can we do to double or triple that organic growth through acquisition and acqui-hires? Because a lot of they're people businesses, so we're not always doing acquisitions. Sometimes we're doing acqui-hires. And then we're looking at a variety of approaches where, like, what's our capacity, like utilization of the team? what are bill rates? What's our leverage model? What are bookings per salesperson? Things like that. And we've got all proprietary metrics of the 40 plus companies that we've owned, platform companies and over hundreds of add-ons. We've kind of got our metrics. We look at value per head, something that probably value per delivery head. People probably don't look at that in non-knowledge and talent-based companies. And so I think we've got other sort of professional and people service company valuation metrics that we look at in addition to, private comps. So.
Yeah. It definitely seems like the benefit of having this focus then gives you the ability to develop insights and tools that allow you to analyze and kind of value these companies in a more nuanced way. What is once you have an initial company, a thesis company that you then have on board, like how do you map out the future add-ons? Like, do you have like a 5-year plan with like exactly what you're going to add each year? Is this more opportunistic? Like, how does that play out once you've got a platform that you're building?
We're fans of that Amazon strategy of sort of they'll write the PR for the new product before they launch it. We in some ways will write like the teaser or the exec summary of our 5-year sim. Our exit materials before we buy the company.
Yeah.
So we've decided on what we want to look like, our future vision. We share that with our management team and we align on a plan to execute that vision. There's generally a 3 to 5 year business plan. And then we have annual, more tactical, like here's our budget, here's our CEO objectives, and that we cascade down through the company, where there's typically CEO level and then company level OKRs that we employ. And that's how we kind of get to our outcomes. There's always a mix of organic growth and acquisition-based growth. It is wrong. It's impossible to get right. So you have to recalibrate every year. That's what we're here for. That's what makes business fun. But we are generally trying to align on a plan, knowing that things won't go according to plan. We'll have to recalibrate a bit, but we think that approach makes a lot of sense. And we try to get really aligned out of the gates, be radically transparent with the operators and the founders and the sellers of what we want to build, why we think this is going to be valuable, why we think this is going to make money on their rollover, money on their incentive equity, and why it's good for the clients, employees, and us, right? And so I would say being radically transparent about the gates and being really thoughtful around what we want to build, not going into a new company and saying, yeah, we're just going to kind of keep riding the work that they've done in the past. Like, we're looking to transform these companies.
Yeah. So. Yeah. As for the kind of founders out there who, are, they're going to need to sell at some point, or they're going to exit somehow, somewhere. But if they're thinking about exit and thinking about exit strategies, what are some of the things that you'd advise them in terms of, I always talk about valuation and then buyability, like things that really kind of move the lever for you in terms of value, and then the things that really drive kind of how buyable a company is, or what's going to make a transaction easier when it comes to kind of the mechanics of selling.
Yeah. I would say first on value, it is obviously like incredibly important to this conversation. Like there is a liquidity, if I'm speaking with a founder, we get it. I need to get it. They need to get it that money is important, and money should be, I would say, top 3 to 5 things. Some people, maybe it's the number one priority in a transaction. For other people, it's not. It shouldn't be. But I think it should be a top priority. And I think to be competitive in this market, you need to be in sort of the upper quartile or so, maybe, of bidders in deals, assuming that's not a proprietary situation. After that, it's, comes back to the fit that we talked about earlier. How much does the sponsor understand the market, understand your business? Do you feel comfortable letting this private equity firm own the company that you built, right? Selling your company is a top, depending on how many kids technically someone has, it could be a top 5, top 10 life event. And we have to treat it with a lot of sensitivity and tact. Not just about the initial acquisition, but also afterwards and how we act as business owners. So I think really sort of going into a sale process and maybe sketching out, like, what are the things I really care about? Sketch it out before it gets emotional and intense, because that is what happens. No matter what, Every
Mhm.
deal at the end, there's always something. Every
Yeah.
deal always has something. And so I think getting it out when you're in kind of a cool, steady state, writing it down and not losing it,
Mhm.
going back to that file throughout the process, definitely towards the end, and saying, okay, am I really meeting my objectives? Am I holding
Yeah.
myself accountable for what I really wanted going in?
Yeah.
Well, I would say that's really important. I know, Bruce, you're like one of the most well thought.
Yeah. I do a lot of those with founders.
But I
What-
think it's so interesting for me to see that, what you and other founders think. Like, I think I get that. And that's why
Mhm.
that's how we differentiate in a way, is we think we understand the sensitivities and are good partners and are good people. And that's a huge part of our differentiation. There's lots of things on the business they need to do going
Yeah.
into a process, like getting their team on board, like figuring out who's going to be in the room, table stake stuff, getting your data together,
Yeah.
getting your systems to tie, being prepared for due diligence, being prepared to answer lots and lots of questions, probably over and over again,
Yeah.
not get frustrated because we're just doing our job, right? We have to do due diligence. That's how it works. So yeah, I think there are those, getting the accounting in place. There's a lot of things to do, but I think we're talking more about like mentally what's preparing for a sale. I think there's a lot that goes into it than just getting the business ready. It's really about getting the founder's mindset ready.
Yeah. Where do you see, I mean, I guess in terms of the experience you've had and the founders you've worked with, where have they kind of missed some of this stuff, or where have you seen founders struggle, either during the sale process, during due diligence, or post transaction, where they haven't anticipated something, or they hadn't realized kind of how it was going to land, or where they were going to struggle with kind of those changes?
Yeah, so we do our best to align with the founder pre-close on what they want to do post-close.
Mm-hmm.
We do our best, right? We spend lots of time. We ask the questions over and over.
Mm-hmm.
We're vetting their sincerity about what they want to do. But at the same time, like, they're humans, we're humans. Like,
Yeah.
we won't know what the other side of a deal is going to look like. No one
Yeah.
can see the future. And so sometimes they think they're going to feel a certain way, and in reality, they feel differently. Things I've seen where a founder is just really eager to get a deal done, and we think we've aligned, we've put this kind of post-closing professional life experience for them, plan in front of them, they've agreed to it. We get post-close, they're no longer a founder or an owner, they're an employee.
Mm-hmm.
That is tough, right?
Uh-huh.
That can be tough. And that's, frankly, for us, fortunately, has only happened really one or two times.
Yeah.
Right. A lot of the other times it's, hey, like, I'm happy to be an employee, but I actually want to step back and be a delivery person or a salesperson or just someone that
CTO.
Exactly, like get into a different piece of the organization because they're intellectually curious. And those are the best outcomes. And then sometimes just people get the check and they weren't thinking about money the way they didn't think they would think a certain way about money. Now they've got the money and they're like, you know what? Life is short. I don't want to work. I want to do other things in my life.
Yeah.
And that happens. And that's okay. Ideally, we would have seen that before it happens. But sometimes it happens. It's human. You can't judge people for it. At the end of the day, I want people to do what they want to do. I hope that they would want me to do what I want to do.
Yeah.
And so I try to take it for what it is and not force people into doing things they don't want to do.
Yeah. Yeah. It's a tough process. I mean, I went through it personally where I was, so focused on trying to get this deal done for all sorts of reasons. Like, it wasn't until I finished the deal and I was back on the other side, and then I was like, oh, wait, I don't know if I actually want to be in this situation anymore. Right. So, I mean, we try, like, I work with all these founders to kind of help them think through that and kind of, project into the future and what's really going to happen. But it's tough. And it's kind of the process is, getting to the other side can be a bit of a challenge, and it's eye opening. Tell me a little bit about, like, where have you seen, I guess, good deals that didn't work because sort of the company wasn't prepared, or you just, they didn't have their ducks in an order, or, there was just things were just not organized well enough. Like, the fundamentals may have been there. It was like, hey, this could have been a good deal, but we just couldn't get to evaluating it, or, we just couldn't get over the finish line because of, kind of lack of preparation, not necessarily lack of fundamentals.
I think this will answer your question. If it doesn't, let me know.
Yeah.
Sometimes companies are expecting a platform multiple. Bankers have pitched a platform multiple, and they are applying it to an EBITDA that is not a platform EBITDA. They don't have a CFO. They don't have a head of HR, right? The founder does everything, and the founder wants to transition, or that founder is going to step back after the deal.
Yeah.
And so I think oftentimes, there's a valuation disconnect with founder-owned companies, because founders, when they own the majority of the company, they're naturally going to play a lot of roles and give more discretionary effort than they would after they sold the company to us, and they're probably a minority owner, or they're in some sort of, deferred consideration period.
Yeah.
So I think that probably has blocked us from doing deals where it was a good company.
Yeah.
We wanted to do the deal, and we just couldn't get there on valuation, because we viewed it as, hey, like, they're missing infrastructure costs, they're missing operational costs that we have to bear. The price just didn't work for us. Price is important, right? In private equity, there's lots of studies that, like, I think we pay market prices for the companies that we're investing in, but we're certainly not paying revenue multiples. We're paying good, solid EBITDA multiples.
Yeah.
And sometimes you just don't get there on price, and that's okay.
Yeah.
And I also don't want to buy a company where the founder feels like they've been shorted and they're not satisfied with the price, because then they're always there's a good chance they hold that back
100%.
kind of deep in there. And so I want our counterparties to be pleased with the price we're paying. And even if we could do the deal at the price, but if the founder doesn't like it, I don't actually want to do the deal.
Yeah. No, exactly.
So I think that would be the most common thing that we've run into. What blocks a good deal. So.
Yeah, good. That's great. I want to just kind of cover a little bit of the broader market right now. I mean, we're in kind of interesting times. We've got, political things going on. We've got tariff things going on. We interest rates that are changing. We've got kind of global conflict. Like, what's your kind of view of the market over the next couple of years when it comes to M&A transactions in this lower market? Like, are you bullish? Or are certain areas you see are going to do better than others? What are the factors that you think need to play out?
I'm going to give you a cop-out answer on I would say I'm neutral plus.
Okay.
A concept that, or a term that one of our CEOs has instilled in me, and I've been saying it all the time now. I have been saying for years that we're going to experience a downturn. At some point, things need to stop going up. That's not how economies work, right? Economies are cyclical in nature. You have inflation, you have rates, you have tariffs, you have macro events that cause political uncertainty or geopolitical uncertainty. And so I think we've been in this sort of craze for a while. And I think this AI boom has driven a lot of appreciation in equity markets. It's been a select number of companies that have experienced it. But AI has certainly propped up the markets this year. And we've sort of had this crazy experience in 2025. So at some point, I think the broader macro economy will turn. Do I think we're going to have a 2008? No, I don't think so. I hope not. I think the world is hopefully, or the economy is in a much smarter place, that we're not going to have a 2008. But I think we will experience some softness in the next 3 years. Okay. For us, and you talk about the market, I'm going to go back to where we invest. We're generally investing, and I think even our competitors that we run into in this end of the market, we're generally investing in smaller, more insulated, recession resilient type companies. Like, I think about like technology spending, healthcare spending, education, for me, legal, accounting, wealth management. Like, these aren't things that go away in the recession. And so more broadly, I think we will see some sort of volatility in the markets in the next 3 years. But I get excited about that. I think there's opportunity for investors across all different asset classes and strategies to find money in these scenarios. I think it's sort of hard in some ways when everything's just kind of going up and to the right for these public market investors, and where a lot of the capital of the institutional allocators sits. And so I feel like that will cascade down to us in the lower market, and there'll be lots of opportunities whenever we hit that sort of market uncertainty that we've all been waiting on.
Yeah. I think we're going to hit time here. Lee, I appreciate this. If people want to get more information on you, the work that you do, about the firm, what's the best way to get that?
Yeah, renovuscapital.com. Emails lee.minkoff@renovuscapital if you want to reach me. Follow us on LinkedIn. We put a bunch of posts out about our companies, our events, and always happy to chat and network and have a conversation. So, Bruce, I appreciate you having me on. It's been fun, over the years, you and I getting to chat on stuff and again, to be on the podcast. I really appreciate it.
Yeah, it's been a pleasure. And I'll make sure all the information is in the show notes. People can get that. Yeah, no, thanks for taking the time. It's been a pleasure.
Thanks.
All right.